Something very rare is happening in markets right now, and it has us a little bit worried as investors and traders. The CPI report is coming, the Fed's decision is on the same day, and we're at all-time highs. But where the problem lies is in the breadth, and we may have heard this before, but as it turns out, we've only seen something similar to this a handful of times. In today's video, we take a look at why the smaller stocks are so weak and how that could be really rewriting history to what section of the cycle we're in at this stage. More importantly than that, we take a look at stocks, commodities, and cryptos to see where the biggest money flows are going right now. Join us, guys. This will be a good one. Well, welcome back, everybody, to The Daily Show. My name's Tom, and as always, we'll be breaking down everything from the macro to the data to the lead indicators and how we need to use them. Now, what's going on at the moment is banks were down, and of course, Apple was up, with AI really leading the charge in terms of ChatGPT integration. If it's your first time here, remember to subscribe and smash that bell icon if you want to understand more about money flow and, of course, educate yourself on these biggest storylines. But let's begin with the big one here, which is pretty much arguably the biggest data point of the month, and that's CPI, the inflation numbers from the US. Now, we've got the game plan here, which you can find over on our X account, and it shows you that 40% of the time, JP Morgan expect between 0.3 and 0.35%. Now, during that event, it's kind of going to be up, down, and all around according to what their read is. But I think it's more important that we look at a few other factors. First up, what do all of the major banks think in terms of consensus? Their consensus is 3.4% for inflation day. And this basically means that if it is different to that by too much, we're going to see increased volatility. So that's the first thing that you'll be looking at. The second thing is that Goldman Sachs have already started to project, and you can probably assume that a few other banks are projecting the same thing, that the FOMC or the inflation target will be reached. And this is, of course, showing the inflation tracker coming down more to the target versus where we are right now. Now, if that's true, and of course, inflation does start to spike rear its ugly head again, probably from shelter, because as we know, shelter is the big issue here, or one of the biggest issues, then that will have markets freaking out because, of course, Goldman Sachs expect a 0.25% increase in May. Now, one of the things that we all look at is usually when we go to the shops. And remember, we've experienced this already, but the economists don't care about us. They only care about this little top-end range. So just remember, yes, we're probably still seeing the signs of inflation going up across the board. The most important thing is going to be the numbers, though, and then what the market chooses to do. As we always say, patience, react, don't predict. There are going to be good opportunities, but they're probably going to be at key levels that we'll break down soon. So 65% of the US stock market is now growth, and allocations are near new records. Now, this is something we've seen during the 60s, which you'll see is a very correlated period right now, and of course the dot-com bubble. And if you've been watching some of our videos, I encourage you to go back over the last two of them in particular, have a look at the overlays with some of the dot-com bubbles and the 1960s levels. You'd be pretty shocked how close they are. Now, are we at the tippity top? Not quite yet, but this does bring up a point because in both of those markets, the 60s and, of course, the dot-com bubble, we saw a lack of breadth. We saw a huge concentration play, and it seems to be happening again. According to Mike Zaccardi over on X, 52-week highs overall were only 66, 52-week lows 173, a shocking difference when you consider it that way. When we have a look at the breadth overall, according to these charts, such as the one here from Grant Hawkridge, you can see breadth has been decreasing, and it also shows you here that it isn't really that supportive with normal economic theory. Usually you want to have bull markets going very, very strong, and you can see only 4 of 10 indicators are in bull market mode compared to where we were only 1 to 2 weeks ago. So as we make these new highs, we're not seeing supportive market conditions. Now, this is where the handful of numbers comes out. You'll notice that this is basically where we get new all-time highs with a lack or a negative number of overall breadth. Now, this is pretty rare because you can see it's only happened a few times, but specifically it happened a lot in the dot-com bubble, and it also happened a bit in the 1960s. Now, funnily enough, they are the two most correlated markets right now. So what are we concerned about? Well, we really need to be watching semiconductors and NVIDIA very closely, as this would state, and you're looking for, I think, these huge concentrations of reads such as this. So it might be something that we're tracking in the future. And specifically, we'll be looking at these types of reads: negative New York Stock Exchange net new highs, negative New York Stock Exchange net advancing issues, and negative New York Stock Exchange net advancing volume. When we get that trifecta, it really is pointing to a very specific time. And again, we've got those types of overlays right now. So I want to just quickly talk here about banks. And this is one of the big reads that I think is really leading into markets improving. Now, of course, the US banks are very similar to this, but I'm just having a look here at the UK banks from Hidden Value Gems. And it shows you that both Barclays, HSBC, Lloyds, and of course NatWest are all on pretty good runs over 2024. Now, why is this? Well, it has a lot to do with the level of customer loans. And you can see here customer loans, 400 billion, customer deposits, 539. Notice HSBC, though, more deposits, less loans overall, running at about a 0.4 ratio. Now, why this is important is because the actual markets are rewarding large debt loans being written. You can see here that we have the hugest gains with some of the biggest writes over the year. And this is kind of showing you that the markets are getting towards a point where they're saying, borrow, 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 debt, debt, debt. That's what we want to see. And that also is helping to, of course, fuel this current market condition. Now, we spoke about NVIDIA and semiconductors before. Did you know that most bear markets start with those particular leaders actually showing signs of weakness? Specifically, if we look at the 2000s run, and of course we go back into the 60s run, you'll notice that we were also in concentrated markets. Back in the 60s, we were in commercial services and real estate. Of course, the dot-com bubble, the most similar to right now with the AI revolution that's going on all around us. And another reason why markets are able to run higher right now has to be the buyback era. So as we know, every single bad result at the moment, don't worry guys, we've got buybacks coming, we're going to buy back the stock, and that's leading on to, I guess you would say, an under supply. And of course, the demand is remaining relatively stable, if not improving in the markets, as we see more and more people pile in to make riches. Earnings versus valuation, this will be a continuous story. So you can see here that earnings has been improving in the stocks that matter, and the forward guidance has been generally doing fairly well. And that's going to mean that we have to look at every single earnings season. But for people thinking that we've topped right now, just remember, if you took 1950s data all the way to today, you would find that that hasn't actually ever happened. We've never seen an actual topping in June, and you have to go all the way back to 1948 to get that last top. So very rare that June is the top of markets. Therefore, you can probably expect more and expect basically pullbacks to be met by bull demand. One of the reasons why we can expect that has to do with concentration. We've seen three major concentrations over the years: the dot-com bubble, right now, and the 1960s. And all of these particular concentration markets ended up having these types of things. Effectively, we had inversion of yield curve, and therefore uninversion of yield curve was the trigger point, or at least a big problem. Remember, central bankers, especially the Federal Reserve, will not usually cut rates unless they break something. So when you look at those narratives, when we look at the 60s, when we look at the 2000s runs, are we near the end yet? Well, it would suggest that we might be in the kind of like last innings, the late cycle kind of run. And it would also suggest that we might continue to see some strength throughout 2024. Most notably here from Ned Davis Research, we can see that markets tend to drive higher throughout election years, often have pullbacks around that August into October period, and then tend to drive higher into the new election cycle, the new president cycle. Another one of the most important factors at the moment is, of course, oil, and we saw this head down to historical low levels. We'll look at the CTA allocation in just a moment. I think that will surprise you, but a lot of stuff going on underneath the hood there. So let's move over now to what's been happening when it comes to flows around the markets. Basically, we've seen semiconductors, technology, and most notably to me, solar, and of course, consumer discretionary doing better over the last 5 days. I think consumer discretionary is a bit of a sleeper hit, and we've been talking about that in our live streams and our Market Masters Club as well. Links in the description if you're interested in joining us. Financials, last 24 hours took a dive, maybe a bit of jitters before the inflation numbers. That will be a very important view. We'll check that out in our next video. And of course, solar continuing to do well, tech, and everything else that really has been kind of rotating. So yeah, metals, banks, all of those types of things down in the lows for now. What about the overall S&P 500? Well, if you zoom this out a little bit, you'll notice that the advanced decline line, which is a great one to have in your charts, has been decreasing as the market's been going up. And this, of course, is a bit of a warning sign for bulls to say, well, maybe the market's not as strong as you might think. I also note that if I have a look at the footprint here over the last 24 hours, while it did close on its highs, you'll notice that there is a decent amount of volume that seemed to come through right at the high points. So that's kind of suggesting that maybe someone sold a little bit into the end of the day. Now let's have a look at the futures market though and try to get a bit of an understanding of what happened. I left the call resistance on for the Tuesday read so you guys could see that this actually hit straight into the target profit of the Tuesday call resistance. Often these are great zones for either finding entries or of course exiting positions if you want to take profits. And where do we find CPI days call resistance? Right at 5,400. So somewhere between 5,400 and the one-day expected options move after CPI, which is 54.11, this is where you'd expect that resistance to come through. So basically we have a resistance bear area up here and we have a bullish area down here. And of course, we've got a lot of range in between that. Day traders will also want to be looking at this box here, which is around the 53, 55, 57 range, as that makes up one of the most traded zones recently. So basically we get pulled back to here, might find a buyer in this zone, might find a buyer down here. And I think if we make this level up here, this is going to be where the sellers kind of sit. So we're in the middle of nowhere land leading into it, which is pretty normal. Usually these types of events, CPI, and of course the Fed conference, that pushes markets to break key zones, or at least to give you that increased volatility. Zero DTEs kind of also show the same thing. 5,400, 5,400, 5,400. We're in positive gamma. If the market keeps pushing up, especially past 5,400, we could see explosive price action move. The price action is still bullish here. And if we get underneath 5,300, 5,285, which has long been where we thought the support was, then we're probably going to move into a negative gamma environment. So at this stage, still quite bullish. When we look at the CTA allocations, they support neutral bullish allocation. NASDAQ, S&P, both bullish. When we have a look at Brent, it's as we suspected, a rally in the CTAs. When we look at gold, still flatlining. So next 24 hours probably going to be quite important for gold. Let's move over now to some of the other interesting stocks. And the first one here has to be Tesla. 170 pressured over the last 24 hours, but continues to be the hold zone. Pretty much all of the strikes have 170 with huge amounts of puts on them. And we know that if the market's able to run through 180, 182.50, it's going to be moving into positive gamma. And if it blows underneath 170, it's going to go negative gamma. And I think 167 in particular will be a very important point for Tesla. And we'll look at that soon. Nvidia, same thing, holding up. As we know, after a split, sometimes it can hold for 1 to 3 days. Historically, a lot of these have been negative. The price action is currently bullish, and really it's going to take a gap down, something like an island reversal, to change Nvidia's trajectory. So at this point, still bullish. So just before we jump into the charts and we keep looking at these key levels together, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, the great thing about Tiger, they're always improving their platform and they've been around for a long time. It's actually their 10th year anniversary and they've been winning a lot of awards recently. But for viewers out there, especially the Australian ones, there are a bunch of special offers right now. If you sign up at the moment, you get $30 worth of Tesla, $30 worth of Nvidia, arguably the best stock in the world at the moment. And because it's their 10th anniversary, you'll go in the prize draw to win an extra $50 worth of Nvidia fractional shares between the June 13th and June 19th. There's never been a better time to open up a Tiger Brokers account, especially if you're from Australia. And some of the reasons why are all of their extra additionals. One of my favorites, of course, being their implementation of US stocks 24/5, which is absolutely amazing for a lot of traders around the world. And of course, another one has been their AI companion. I'm actually finding this to be quite good when it comes to reading reports. It's not too bad and it's quite fast. So if you ever want to kind of take the hassle out of reading an article, you can use it to analyze those, such as here with analyzing BHP, an Australian stock, and it should help you to make those kind of quicker decisions and of course get the information at your fingertips. So there's never been a better time to check them out. Why not do so? Links in the description, guys. And remember, they've been around for quite some time now, and they're always taking on feedback, which I think is excellent. All right, let's jump into the charts, and we'll start off here with what's going on in terms of options, and we'll begin with the bonds market. So the bonds market and options not showing those warning signs just yet. The yield trapped between 4.7 and 5. Of course, you'll want to set those alerts for both of those edges, and treasuries therefore floating around in the middle of nowhere land, which is pretty much expected. Home builders right on support or demand ahead of the big event, so we know that's going to be an important factor. And then we get Dow Jones Transportation Average also sitting right on that supportive zone. S&P 500 and central bank liquidity, both central bank liquidity reads are coming in stable. This may change after CPI, so stick around for our next video when we actually cover all of that. And the Dow Jones, the dollar index is sitting right on that most traded level. So again, right at the supply zone, and it's looked very bullish since the non-farm payrolls. We spoke about the trap that was set by the non-farm payrolls in our last video. And again, this is now setting up for a bit of a blockbuster. Currently, it's making a series of higher highs and higher lows. So it's in a bullish trend on the smaller time frames, but that could change, especially if we take something like the 105 level on the US dollar. And if that happens, we stick it, there could be a good short trade here. And I think it's worthwhile very much paying attention to the daily close and the smaller time frames on the US dollar. This leads into copper, hasn't broken above 470. If it does, starting to look very good for swing traders, holding its own right at that watch reaction here, right where we expected it to hit. 450 was one of our targets, so we're looking to see whether there's a buyer there. Now, gold is something similar. It's come down to that very important level. Some people are looking at this from a double top perspective. And in this case, you can really see that if it breaks this level, the next logical zone is going to be actually quite a lot lower, 2170 to 2200. This area in here will become the next kind of logical zone. So it's very important that gold holds up. Swing traders are probably going to need to wait for it to get through here. But I think silver might hold the key on the small time frames. So let's take a look at silver. I'm looking at 2987 closure above to be quite significant for silver bulls. And at the moment, it's in a downward trend. So you need to remain kind of calm, remain cool, patience, react, don't predict. Most of the time, these CPI days, the best trade is after the news event, after you've seen the market go wild and hit a bunch of key levels. US oil continues to drive harder and higher. 80.60 would be a breakout for swing traders, kind of pointing towards every pullback from then on being quite bullish. The key level the other day, the big positional level, was hit, and we certainly liked that, but it didn't enable a really easy trade unless you just went engulf candle, buy, stop below the low, and rallied it up. That would have been okay as well. Tesla holding between 170 and 180 still. Looked a bit gnarly. It didn't look very good, but it did manage to find a buy straight away. So I think a break below here and close, that could expose like a 140, 145 for Tesla. At the moment, it's still trapped, though, between those two option zones. So maybe CPI will get it out. NVIDIA, something similar. Still a series of higher highs and higher lows. Trend is up, but it is randomly sitting within a range. So if this gap's below, that would be, of course, that classic island reversal setup. And although, shorting the best stock in the world is not really the best idea right now, that could be a signal that the markets are starting to tip a little bit based on some of that breadth information, maybe a little bit of inherent weakness coming through. So NVIDIA, one to watch, along with semiconductors. As we mentioned before, the American consumer discretionary versus staples, has been hovering. And this to me is that sign similar to what we saw in solar, where it's a little bit of flow increase. Things like Shop, things like Nike and many, many other consumer discretionaries slowly finding bases over recent weeks. And then we move over to HSI. Now, I won't mention HSI too much because obviously we know the key levels based on our previous video, but I did notice that Tencent, one of the best stocks in the Chinese market, has actually shown signs of a little bit of potential here in terms of leading through. Now, if we get another high past this point here, which would be 391, you've got to remember this is one of the stocks that got really bought up ahead of the HSI move. So it was kind of like the first mover. And that's usually what happens. One of the best stocks usually leads, and then the rest of the market comes with it. So I'm interested to see here what happens with Tencent. Obviously, you do not want it to a new low. That's going to be quite weak, but it is holding up very nicely. And if that finds a bid, I could see it being a bit of a catalyst. Aussie 200 market, for anyone in Australia, It's basically sitting around the most traded level. So 7,700 is kind of like the most traded level. So just sitting on support, awaiting the US markets. What about the Dow? Well, it's still weak underneath this supply, but I would suggest sending some alerts at 39,250. A break above that could signify an overall market rally that could even push through 5,400. So Dow, actually an interesting chart at the moment. It is still short on smaller timeframes. So basically, if you look at something like a 2 hour, it kind of signified weakness, and it signified that somewhere in here is kind of where the shorter is. So yeah, there's a bit of a bear in the Dow for now, but that could change after the inflation number. Remember, patience, react, don't predict. Tweezer on the Russell 2000, break above. As you can see here, the two tweezer, it's very strong kind of level. Generally, if it does break above, that is kind of consistent with nice strength there in the markets. NASDAQ keep going up. Basically, there's no weakness on this market at this stage. Of course, Apple leading to that. Now we move over to Bitcoin. Now I've had a look at a couple of levels here. It actually did exactly what I'd hoped it would do, which I know seems weird. I wanted it to come down into this market level here, and I wanted to find a buyer. Now it did find a buyer, and now actually I want it to drop again and do something like this, or just rally back through 70,200. And at this point, if that happens, I'd say we're probably going to break that 72.5 zone. And as you know, that would be very strong for the crypto market. Interesting report coming up soon. We'll cover that in more detail in the next video. CPI coming out 8:30 New York time, guys. FOMC press conference 2:30 p.m. That often reverses stuff. And don't forget PPI the next day. A lot of economic news. This is going to be quite volatile. So that brings us to the end of the video, guys. A lot of interesting things going on. A big shout out to Tiger Brokers for sponsoring today's video. Remember, if you're from Australia, between June 13th and June 19th, you'll be able to take advantage of their special Tiger 10th anniversary draw. And do remember as well, they've got all these extra features that they keep adding to the charts, and especially the US stocks 24/5. If you want to find out more about what we do, you can follow us on some of the socials, and we'll see you in the next video. This is sure to be a volatile day, and I'm sure we're going to get to some key levels across many markets. Bye for now. I look forward to seeing you on the other side.